The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Greg McDermott with Cyber Trading University welcoming you to our Options Advantage free webinar. I appreciate everybody joining us this evening. We are going to get right to it. I know everybody's time is valuable, and I appreciate you taking some time to be with us this evening. Let's get through the required elements of the program. The CTU risk disclaimer, give you a moment to read through that. We'll follow up the risk disclaimer with some information about Cyber Trading University. Most of you are probably familiar with us, but just in case, CTU has been an educational trading institution since 1995. CTU established itself as a leader, first by working directly with the SOE's trading firms, teaching them to day trade. Cyber Trading University was one of the first to establish itself as a quality stock market trading school. Each instructor, including myself, has a minimum of 6 years actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders, and the CTU headquarters are located in the heart of the trading world in New York. My mom's favorite slide, that's me, Gregory McDermott, earned my master's degree of applied finance from Macquarie University in Sydney, Australia, bachelor's of financial management from St. Joseph's University. I was a crude oil options trader at the New York Mercantile Exchange. I was the head options market maker on the floor for JAS Securities at the Philadelphia Stock Exchange. While in Philly, I managed our firm's portfolio risk for our team of 10 options floor traders. I was also a market maker in the Dell computer crowd, which at the time was the busiest equity option traded in the U.S. Also directed an off-floor trading unit for JAS, and while I was there, I qualified with the ICE, the ISE, the International Securities Exchange, as a DTR. So most of you probably joined us this evening with some version of this question dancing around in your head. Why should I trade options? Well, what I'm going to do tonight is give you a real good feel for the clear advantages for trading options. And when I'm talking about this, I'm talking about trading options for those traders who are looking to carry positions for a little bit of time. Let's call them swing traders. If you're somebody who's going to be in and out of the market, like the guys in the cyber group, who trade with Fausto, the options would not be to your advantage. But if you plan to hold the position for any length of time, anything over, I would say, a few hours, particularly if you were going to have anything where you would hold it overnight, we're going to talk about those types of traders. We're going to focus on equities, but the same ideas apply whether you're trading FX, trading futures, options on currencies, options on equities, any of those. But we're going to focus on equities tonight, and we're going to explain to you why, if you're that kind of a trader and you're looking to develop those sort of trading skills, why you need to be trading options for a number of different reasons. And here they are in a list. We're going to talk about the capital efficiencies, pardon me, the limited risk, and I did say limited risk and risk reduction, contrary to what Mr. Buffett may, and I don't mean Jimmy, I mean Warren, might believe. The superior alternative to shorting stock, additional means to profit with greater choice, position integrity after taking profit. In fact, we just did that one of our trades in the cyber group. Timely and flexible portfolio protection, income generation methods, and the ability to cancel out that ever-present and always bothersome market noise. Yes, we are going to own or hold options contracts. That's what we're going to be talking about, Vincent. Let's start with the most obvious, the most basic, the simplest, the capital efficiencies available to you if you are trading options. I just want to double back to make sure, yes, we are recording. Let's say you're a trader and you want to buy 100 shares of the ever-popular, always tradable XYZ stock. And XYZ is currently trading at $100. Well, that's going to cost you $10,000 to buy 100 shares of that stock, which is a lot of money in anybody's account. And it's not a lot of stock, to be honest with you. But you could control the same amount if you bought, for example, one January 100 call for XYZ stock. You'd pay $10 for that call. That would be $1,000 out of your account. So you'd get to control the same amount of stock at a 90% discount. Now, let's be clear. If you buy stock, for better or worse, you can own that forever, whereas an option does expire. You are on some level renting the ability. And when you buy a call, you buy the right but not the obligation to exercise that call anytime up to and including the expiration of the option. If you buy a put, you have the right but not the obligation to sell. And when I say right but not obligation, that's integral, that's important, that's key to what we're going to be talking about. And what you won't hear me talking about when you're talking about trading options is you're not going to hear me talking about any positions where you would be net short or naked short options. Those types of positions can blow out even the most skilled trader's account. I was at a trade show in Vegas years ago, and one of the groups that does options trading called everybody over to their group, their seminar. It was such a good seminar that they had to give away live casino chips to get people to come sit down. I should have known at that point that there was probably not going to be much value in it, but I went anyway. Got my free casino chip, and the gentleman went through a presentation and showed us how you could do, using live trades today, how you could do this vertical spread, and you could get a credit by selling two of these and buying one of those. And I turned to the nice lady sitting next to me and said, I wouldn't do that trade with their money because it was a riskier trade than they were letting on. And you're never going to hear me talk about those types of trades. Is it possible we'll talk about at some point in your options education about selling call spreads or put spreads? Absolutely, positively. But we're talking about vertical spreads normally, or at least measured spreads where you are long as many as you are short in the same month to prevent the catastrophes that can happen. So the other thing I do want to point out here is this is not a call to say, hey, well, I can use the leverage of options, and we'll talk about leverage, but I can use the leverage of options to push all my chips to the middle of the table, thereby taking as much risk as possible. That's not what we do. That's gambling. That's not trading. That's not what we're going to talk about here. So back to our example, we can, for $1,000, control the same amount of shares as if we bought 100 shares in the market. What could you do with that $9,000? Well, you could deposit it in a money market account, earn a modest, and when I say modest, I mean almost nothing, but modest return of interest. You could invest in other options of other companies and expand your portfolio and spread the risk around. You could also utilize it for alternative investments. The key is you're only out $1,000 to control the same amount of stock, albeit for a limited period of time. And what comes with that limited period of time are some other benefits that we're going to talk about coming up. Let's talk about this. Let's say in a stock scenario, you have a stock position where you pay $58.53 for stock. Scenario 2, you buy an October 55 call and pay $3.90. Then we have two expirations, and this is going to show you about the limited risk and risk reduction of options. And in our example, our stock closes either at 60, and we'll walk through those numbers, or the stock closes, at 55, and we'll walk through those numbers. So let's just think about it. If we owned the stock and we bought it at $58.53 and sold it for $60, we would make 2.5% return on our money. If we bought October 55 calls for $3.90, again, stock closes at 60, so our 55 calls would be worth $5. We would end up making a 28% return on our money. So options do provide leverage, but leverage isn't always a good thing. Don't be fooled necessarily by the percentages, and I'm going to show you why. Stock falls, as we see up here, to 55 at expiration. We paid $58.53. We sell it at $55. We lose 6% of our investment. October 55 calls. We paid $3.90, but they're now worth zero. So we have 100% loss, although note that the cash difference is not that great. So we want to avoid holding these losing stocks as if that's a real revelation there. Leverage works both ways. So we've talked about more of that limited loss. Now, again, that's the capital efficiencies we talked about here where we're only putting limited capital at risk. But here's the limited loss risk reduction piece that I like so much. Let's assume, God forbid, that our stock goes Enron. For those of you that don't know what Enron is, Google it, and you'll find a stock that fell from the highest of highs to zero. But in our example, our stock, if we own 1,000 shares of stock at $58.53, we have $58,530 of exposure. Our calls, we bought 10 of them in this example. So we have at $3.90. We therefore have $3,900 of exposures. Both positions control 1,000 shares of stock. The question becomes, what's the most you can lose in each of these scenarios? I'm going to take a moment. If you have a stock position, let's say it goes to zero. What's the most you can lose with your stock, and what's the most you can lose with your options? I don't see any answers. Oh, there we go. There we go, some answers. Correct, Donald? All of it is the correct answer. The full investment. What's this show us? That options provide protection. When you buy a call or buy a put, all you can lose, regardless of where the stock goes, the most you can lose is what you paid for those options, whether they be calls or puts. With the stock, you have loss potential down to zero. Now, I'm sure there are some of you, and it comes up in a little bit of the presentation, but I will jump ahead a bit. I'm sure there are some of you that are saying, Greg, I'm a savvy stock trader. I would have had a stop loss in position and at $50, for example, and I never would have had this kind of exposure. Well, the truth of the matter is, I think a stop loss order may be the most misunderstood and mistrusted order known to a trader, because most people believe that if you have a $50 stop loss, that means that you sell the stock at $50 when it gets there. When in reality, what a stop loss order is, it says that when the underlying trades at or below, in this example, our $50 level, the order turns into a market order. But what do almost all really bad pieces of news have in common? Normally happen while we're asleep and the market's closed. What's that mean? That means that your stop order is not doing you any good if the market is closed. So let's take our example. XYZ stock, we find out that we thought that it cured cancer, and now we find out that it causes cancer in everyone. Even if you've ever just owned the stock, it will, God forbid, it will give you cancer. So when that news comes out, it closed yesterday at $58.53. It opens today at first print, $10. Second print, $10. Your $50 stop loss order got you out at $10. Why is that? Because the first trade at or below $50 was $10. The next trade, which you now have a market order to sell, it prints again at $10. Therefore, your stop order is executed at $10. Again, an extreme example to make a point. And what you'll find, and it comes up in this PowerPoint in a moment, but I'm going to touch on it now, is that the options are out there protecting you 24 hours a day, 7 days a week until they expire. You always have the right but not the obligation as long as you own the options. So in this example, stock goes to $10. You own the 55 calls. You know what you do? You don't exercise them. You let them expire and you lose your $3,900, and you're really happy that you had options and not stock, because you'd be in a bad way right now. In fact, a very recent example, although I don't know, there aren't a lot of retail options traded on the euro versus the Swissy. There are some traded on the dollar versus the Swissy, but if you may have seen, that got rocked this week. And if you had owned the underlying, the cash market, you could have been at risk. If you owned options, you have a limited risk based on simply the design of options. Let me check if there's some questions up there before we move on, because this is really contrary to what people believe. People believe options are very, very risky. Done properly, they can be the safest way to trade. Yeah, you guys are all on the money there. Those gaps will get you all the time. So long options have limited risk. I touched on it. You can only lose what you pay, and you're immune to those stop order catastrophes. You can sleep at night when you've got those options positions. It really is. It's a full-time hedge, and to me, that's very important. When you hear me talk about trading and trading options in particular, I always sort of come at it, having been a floor trader, from that kind of mentality. And what I really think about is, what's my worst case? What's my downside? And if you can quantify, get your head around what your downside is, it makes trading a lot easier, because you have a tendency to focus, and you'll hear people who will want to teach you about options and trading, hey, this is how much money you can make. And what I prefer to look at is, okay, if I have an opportunity, first, how much can I lose? How can I be sure of that? And then, is the risk that I'm willing to take reasonable for the amount of profit I think can occur? With options, you always know your ultimate worst case scenario. It's very simple. It's right there. If you buy a spread or sell a spread, you know your ultimate your downside. Now, most of these, if you buy a call, for example, you know your downside. Theoretically, your upside's unlimited. But that's the key. Once you identify the downside, the risk in the trade, then decide, is the profit potential worth the risk? You don't want to risk $1 to make a dime. That's a tough strategy to make money on. People would say you have to do it on volume, which would be wrong. But my point is, you really have to think about it. And the easiest way to determine your risk, because we all know when you put in orders in stocks, or maybe even in currencies, but in stocks in particular, those stops move, and it's easy to find yourself moving stops because, no, it's going to go my way. I just want to stay in the trade a little bit longer. And I believe the fact that you have full-time hedge position on with options allows you to stay in trades that, if you were in the cash market, your risk management would tell you to get out. But because you know your absolute risk and you have risk parameters set solidly for you, you've clearly identified the downside. That makes finding the opportunities on the upside, I think, a lot easier. Just the way I like to look at it. Again, figure out what your downside is, then worry about, can you achieve profit that makes that reasonable? Yes, I'm telling you that options are safe. Owning options. Repair strategies. There are people out there who will tell you that there are ways, and there are repair strategies for bad options trades. The one that nobody ever talks about is just get out. I find it much easier to make a decision about a position without a position on. I think better decisions are made that way. Yes, you can take a call and turn it into a vertical. There's all sorts of ways, you can be taught how to turn positions around, but the question is sometimes, are they worth saving? Is the patient dead, and should we just move on? And that's, I think, something that people are afraid to talk about. Look, you're going to have losing trades, and sometimes you need to just take your loss and move on. Nobody likes to take losses. Nobody on this call wants to take losses. I sure as heck don't want to, but they happen. So when they happen, you have to be prepared to have a plan, get out, and then reevaluate. Superior alternative to shorting stock. This one, I think we're going to find very little. As stock traders, there can be margin requirements that make shorting stock difficult. You may not have enough cash to carry those. There are some SEC rules that can prevent you from placing those trades. There's uptick rules. Some brokerages, in fact, won't simply let you short a stock because of the risk. And the unlimited upside risk, a lot of investors fear short sales. I mean, there are people out there who really believe that up is good for the stock market and down is bad. And if you're somebody who shorts a stock, that's equivalent to rooting for Ivan Drago in Rocky IV. You just don't do that. You root for Rocky. You don't root for Ivan Drago. Well, I disagree. I'm a believer that if opportunity presents itself on the downside, you should be able to take advantage of that as easily as the upside. And the other piece that most people don't realize is there is a requirement for you to short a stock. You have to find, or your brokerage house has to find, someone who is long the stock willing to lend it to you. You have to borrow stock. And there are stocks out there that are hard to borrow. What's that mean? Well, when I traded Dell seemingly 100 years ago, but it wasn't quite that long ago, when I traded Dell, it used to be a hard-to-borrow stock. And if you took an overnight position that was short stock, there was a chance that your brokerage house could simply take away your short stock because they were unable to borrow long stock against it. And every day, the nice woman would come down, Michelle would say, hey, guys, we've got $50,000 to buy, at risk. Now, normally, nothing happened. Well, one day, I came in the morning, and my brokerage firm had taken away 10,000 of my short shares of my Dell position. And the gentleman who owned our firm called up to the highest ranks of Spear, Leeds, and Kellogg's, telling anyone, that was our brokerage, our clearing firm, telling anyone who was, listen, and I'll leave out all the very colorful words I'm sure Jeff used, telling them that in no uncertain terms that they were never, ever, ever to touch his short stock again. And luckily for me, Dell opened up that morning. I was able to reestablish my short position with a couple of bucks for the good guys. But you literally have to be able to borrow it. In some stocks, you can't borrow. You're not up against that when trading options. Let me check these questions. Someone's saying that we should not use stop orders. No, I'm saying you have to use them, but I'm telling you that they're not as effective as owning options or using options to protect your position. Hey, Tracy, how are you? Good to see you out there. So you can eliminate a lot of these concerns with short stocks with options. And there's plenty of ways to get short very safely with options. Just simply buying a put gives you the right but not the obligation to sell the underlying anytime up till expiration. You pay a premium, you pay a fee, you own the option, and you own the right but not the obligation to sell. Nothing wrong with that. And there's plenty of money. Just think about, even when you talk about something that goes up, and if you thought of a stock, and excuse my rudimentary drawing, but when stocks go up, people think, wow, that thing just went like that. Well, we know that stocks don't go up like that. They kind of go up and down and 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 up and down. You know what I mean? there's movement in there. And if you're only going to play the upside of that trade, you're leaving a lot of room on the table. You're leaving a lot of money on the table. And there are times when, the market is coming down. Now, again, we've had some down days over the last couple of weeks. If you're somebody who only trades to the upside, you're kind of sitting on the sidelines. It's kind of hard to be the guy or the woman in there buying stocks when, the market is crashing and you're trying to, possibly catch the falling knife, as the saying goes. That's a tough thing to do. A lot easier to do with options, whether it's getting short or even trying to buy a bounce. It's safer and easier to do with options. Let me double check the questions. Additional means to profit over equities. Like I was saying, easy to trade in a bull market or a bear market. Market's going up, you can buy calls or call spreads, maybe sell put spreads. You can buy put options or buy put spreads or sell call spreads. There's varying degrees of simple to intricate strategies. You're going to hear about when we teach the phase 3 options, we talk about condors and iron condors and butterflies and iron butterflies, and they sound really cool, and all they really are pieces. In fact, the simplest building block of any of those strategies is really just a vertical spread, the simultaneous purchase and sale of 2 calls or 2 puts in the same month at different strikes. And you kind of build those strategies around that simple building block. And you can trade straight direction, but the advantage of trading direction is that you can do it very, very safely. Like right now in our cyber group, which we're going to, at the end, we'll give you guys an invitation and an offer to come join the cyber group for a week. But in the cyber group, I get in every day around lunchtime, and we talk about options. And some people were saying, hey, what about oil? What about oil? And clearly oil is at a real low point right now. And they were sort of, the people in the group were kind of like, hey, how would you play this thing, Greg, if you thought, oil was going to go up? So we went and pulled up the USO, which is the U.S. oil index. It doesn't equate directly to the barrel price of Texas light sweet crude traded at the NYMEX, which is what, 40-ish something. I don't know the exact number today, but I know OPEC is, they're talking about it getting below 40, down towards 30, which would be great at the gas tank, at the gas pump. But anyway, they were saying, hey, Greg, how would we trade that to the upside? Well, so they were looking for a bullish position, and the underlying was trading at about $18, the underlying index. And the high had been well above 30 within the last year. The index had clearly come down as oil prices came down. No surprise. But the people in the group were saying, hey, Greg, how would we trade this if we thought from here it was going to go up? So what we did was we did a vertical spread, and we bought the 18 calls and sold the 28 calls. Now, and I believe we bought them out did we buy January or did we buy April? I think we might have bought April. Yeah, I think we bought April. I think they were Aprils we did. So we gave ourselves a few months, and we bought the 18 calls and sold the 28 calls. What's that mean? We own a $10 vertical call spread. The max value that spread can be worth at expiration is $10. The worst it could be worth is $0. And we paid about $1.60 for that trade. So it did a couple of things. It gave us limited risk because we only paid $1.60 for it. Our earnings potential were over 6 to 1 because we can lose $1.60, but it could be worth $10 at expiration. So a 6 to 1 ratio to me, I love one like that. 2 to 1 is your minimum to me, but 6 to 1 is just like, wow, I love that. I could see it going back up, and they were asking how would you play it, but that was a completely directional trade, nothing more, nothing less, and we were able to reduce our cost of the call we wanted to buy by selling an upside call and giving up some of our upside potential. Just a simple vertical spread. You can also trade the lack of movement. How many of you have been in the stock market in a day and it just seems like everything is sitting there? Well, options provide strategies that can profit from the lack of movement in stock. Stocks that just sit for a period of time. You can develop option strategies that can capitalize on the simple lack of movement and the general passage of time. You can also trade volatility. Any of you that are new to options, there's a lot of things about the value of an option that is very easily identifiable. The underlying stock, the stock's price, the expiration month we're talking about, the interest rate we're using, the strike price. Those are all well known. But volatility is the piece that we don't know. But you can trade volatility as a simple, as a component in and of itself. In fact, we did a trade in volatility by trading the VIX. If any of you are familiar with the VIX, we were able to do a VIX trade the other day, and we were, again, as a hedge against this volatility, as the market goes down in general, volatility goes up. So the VIX, the VIX, is a representation of the volatility in the market. When the volatility is low, that means there's not normally a lot of panic in the market. When the markets get a little on edge, volatility has a tendency to creep up. So as a hedge against this volatility, we did a VIX trade. Same thing, we did a vertical trade, but what we did was we bought volatility at the money at about 70 volatility, and we were able to sell some 104 vol out of the money. Love doing that, but it's a simple volatility trade. That's all we're doing. We're trading a component of the market, and we can develop strategies to do that. And here's the other one. I touched on it a moment ago, but the simple passage of time. You can set up spreads that benefit from the clock ticking. You know, market makers love selling options on Fridays because 3 days later they're worth 3 days less of time premium. Why is that? They're 3 days closer to expiring, so there's less chance that that option can finish in the money. And we can give you those kind of strategies too. All available, very, very simple to do. Check for questions. I will. I'll use a darker color, guys. Sorry. Yes. Celine, the fear gauge is the VIX. Exactly. I didn't use that term, but you're exactly right. The fear gauge. I use that again. We're talking just that's a representation of fear in my mind, and it's a way to kind of, when things go nuts, volatility has a tendency to spike when the market goes down. There's very rarely a panic to the upside. People are usually pretty orderly as a market and happy as a market moves up, but downside causes fear, and that fear gauge really, to me, it's a great indicator of what's going on. It gives you sort of the temperature of the market. Do you recommend any delta ratios in your spreads? I try not to do ratio spreads, and the reason is, William, is that in order to match the ratios, you normally have to be long or short out of balance. Now, if you're long more options than you're short, I don't necessarily have a problem with it. And when I say that, you're long 2 and short 1, then I can live with that. But I don't ever want to put it in a position where you're going to be net short options, where you're in a position that is a negative position, because Celine just said with the fear index, you can't, when you need to get those options back, God forbid on the puts on the downside, you just can never get them back. The price just runs away from you, and you can really get blown out very quickly. That's how you put yourself in danger. That's how you take the safety of options, turn it on its side, and use it as a sword against you. And we don't want to do that. Position integrity after, and I did say after, profit taking. If I could just get my mouse to jump in. There are many ways to reduce or modify risk when your primary position need not be adjusted. This can allow investors to change opinions in ever-changing markets. They can do position modifications. A lot of times, the cost efficiencies keep you psychologically flexible, and full stock position trading round trip. So what we're talking about here is there are ways to protect and modify a stock position by using options for short or long periods of time. You also can allow yourself to stay in a position. So in one example, let's say you own a stock and it's coming up to an earnings and you don't want to sell the stock for whatever reason. Let's say you're in a company and a lot of your retirement is in a particular stock. Well, what happens is you can use options as a short term, and this is just one example, as a short term, let's say you're worried about the downside. Well, you could buy some puts to protect your position for a period of time, and once whatever the uncertainty there is in the market that has you concerned goes by the wayside, you could sell those puts back out. You can buy them as sort of a temporary hedge against your position. And one of the other things you can do is when you're talking about straight, let me just show you. Let me finish this one. The other option, no pun intended, the other way that you can use options when taking profits is we had a trade that we did in the cyber group, I don't know, 2 or 3 weeks ago. The stock is EXC, Exelon Energy. Please, this is not a recommendation to buy or sell Exelon Energy. Please, I'm not saying that. But what I'm saying is a couple of weeks ago, kind of liked it to the upside for a number of reasons. Stock was trading around 37. Well, we bought the 37 calls, I guess a month out, get a little bit of delta, and we were slightly in the money. Stock was trading around 37, let's say in a quarter, something like that. Well, it moved up about $1 or so, and instead of if you owned the stock at 37 and it went to 38, the only way to take profit there is to do what? It's to sell the stock. Well, we took the options, and what we did was I rolled up. I sold the 37s, bought the 38s, took some profit off the table. Now I own the 38s with the stock around 38 or so. And wouldn't you know it, it happened again. Stock traded up over 39. So we sold the 38s out, bought the 39s. We're still out in February, and we took a little bit of money off the table again, put some profit in, and we still own the 39s. Well, the story doesn't have a completely happy ending, and if they all did, you'd know I was lying to you, and I wouldn't do that. Stock has since traded back down to around 37.5. Honestly, it's shown a little bit of strength recently. This is not a recommendation to buy or sell EXC, Exelon Energy. Please, it's an example. And so we're still in the trade. We own the 39 calls, but now we own them effectively for free because we were able to take profit on the 37 sale, take profit on the 38 sale. We took some money off the table, and we're still in the trade. We still own 10 calls in February. We now needed to go higher for us to make some more money, but we're able to stay in the trade. That's part of the beauty. You can get in a trade. If it's going your way, take a little money off the table. I'm a huge fan of money off the table in your pocket, and that's what you need to think about. Options allow you to do that. You clearly can't do that without altering your overall position in stock. Portfolio protection, and this is one, if you want to use options in a little bit broader sense, let's say, I touched on earlier, let's say your retirement account is completely in stocks. Let's say it's matched completely to the S&P 500. Well, you could think about buying some S&P puts to protect your downside. And what would that help you do? It would give you the right but not the obligation to sell if something went against you. I'm going to give you an old but useful example. These puts that you buy gain value as your underlying trades lower, and they can offset the profit from the puts could offset the loss in the stock or the portfolio. Again, you can also use it to protect a portfolio, and you can come up with lots of strategies based on your need. So the beauty is once you close out these positions, your original position's back intact. Now let's look at, again, I won't even go over the stops again. We know that they're notoriously unreliable. Let's take a look at this example. This is an old one. You can tell because it's rim. It's a really old one. But like earnings have negative gaps. Never a good thing. But the puts, this is an old example, but with the diamonds trading 127.79, you could have bought the January 112 puts. This was a live example back in the day. 112 puts for $6.50 with the stock trade with the underlying trading up here. On January 15th, the diamonds were trading 82.18, and those January puts that we bought were now trading at $29.82. So you made $2,332 on every put. If you wanted to stay in your diamond position, but you wanted to protect it, you couldn't get out, but you wanted to protect it, that hedge would have offset a significant portion of your losses simply by owning those puts. It's a protection. So in the diamond example, you established the put position to protect yourself, which it did. Bought the Jan puts, cost you $650 per, and you vary the hedge based on your portfolio. They're now worth $29.82, and you've saved yourself a gigantic loss. Again, quick old example, but it works. Now the income generation methods. This isn't possible with stock only. Selling options strategically can provide additional sources of income. Okay, now more than one of you is now saying, wait a second, Greg. You gave us this whole big speech about never selling options earlier. What the heck are you talking about? Well, this is called, and you've heard people call this, covered calls. So yes, I am selling an upside call in this example, but I have enough stock ownership to cover that. So I'm technically not naked short those. If I'm long 1,000 shares of stock, I can only sell up to 10 calls because those 10 calls, 100 shares apiece, are worth 1,000 shares of stock. So in a worst case scenario, if it blows through my strike, and in our example, what would you do? Stock's trading at 50. You own 1,000 shares of XYZ stock at 50. The 55 calls are $1 bid for, let's say, February. So you say, hey, you know what? I would sell the stock at 55 if it got there anyway. I'll sell the 55 calls for $1, hoping that the stock doesn't go to 55 or above 55. Because if it doesn't, then I was able to collect $1 premium or $100 times 10 contracts. I was able to collect $1,000 in premium for options that expired worthless. Where's the risk in that position? The risk is, well, there's two risks. One, there's the risk that the stock runs up. You have to sell the stock at $55 regardless of where it goes. But you enter the trade knowing that your effective selling price from the stock in a worst case scenario would be $56. $55 strike plus the $1 that you took in premium, $56. You own it at 50, you make $6. The real worst case is stock gets crushed. Now, the $1 you made in premium doesn't offset all of your losses, but it does give you $1 back on each of your the contracts that you lost. So this you'll hear people talk about covered calls. It's a legitimate strategy if you own the stock. It can be an expensive strategy if you want to initiate the position because you have to buy the stock outright and sell the calls. And the all-in cost of doing that may not be worth the return. In our example, if you had $50,000 worth of exposure to earn $1,000, which is a 2% return monthly, some might say, "Hey, that's worth doing it. I'll do that trade." Others may say, "Hey, that's not worth my risk reward." So it's a trade that if you own a stock position, you can initiate using the sale of options. The decaying premium can add to your income, but again, you have to be covered owning enough stock in case the calls get taken away from you. Provide some limited protection in the event of the counter move, which I just talked about. There are other ways to do it. Some people do things called buy rights, which is where you go to the market and buy the stock and sell the calls at a specific price as a package in order to not lose the underlying. Because if not, you have to do it as two separate transactions, and there is some risk of slippage in either the options. Slippage, by that I mean the price that you want to do the trade at moving away from you in the underlying or the options. Let me check the questions. What's the optimal strategy for zeroing in on the strike price? That's kind of an open-ended question. You know what? Let's, at the end, after I stop recording, I will try to stay on and answer some of these questions in a little bit more free form, because that's kind of an essay answer, not a true false, and I don't want to take up too much time here. If you own the stock, though, doing covered calls can be a profitable strategy. It takes a little capital to own the stock to do it, but it can be profitable. This is one of my favorite pieces. The ability to gain some patience with options. I talked about it earlier. When you're thinking about options, you're thinking about what's my risk. I have a great example. We were trading currency options in the cyber group, and we put on a trade. It was a while ago, and the underlying was trading at about 108.80, and we were going to get short. So I decided, because it looked a little like it could take a little bit of time and that my risk management from the cash perspective wouldn't really handle it, we should do options. So we bought 10 put options. Well, as luck would have it, as soon as we bought the underlying, bought the puts, you know what happened, right? It goes up. I mean, that's just Murphy's Law. But we had bought a 2-month out option, and because we built that into our risk tolerance, we were able to wait out the stock. Pardon me, the underlying, the dollar yen. And it did trade up to over 110 at that point, went against me, 150 basis points, which would have 150 pips, which normally if I was trading the cash, I'd have been out. But I built that into the trade kind of knowing that I might be a little bit early. The story gets better. It opens down. It trades down below where we got in. It went down. I guess we probably got out with the underlying around, I'm going to say 107. It traded down to about 105. I mean, I'm not telling you and I'm never going to, anybody who tells you that they sold the top and bought the bottom, those people are being disingenuous, because nobody does that. You get lucky. It's a miracle. So we got out early, but we made a profit. But the idea was we had the patience because we had the options. We knew what our maximum risk was. We knew what our maximum loss was getting into the trade. That's key. It makes it a lot easier, and it makes it not as, you don't have to be as absolutely perfect. It gives you a little wiggle room to be wrong. I mean, you can ask my wife. I'm wrong a lot. And the ability for the options to sort of balance that out leads us to our next point. You can maintain positive psychology. The toughest part about trading is conquering the distance between your left ear and your right ear. It's your brain. You're your own worst enemy. You get in your head and you think things are going against you. We all have had it, right? As soon as you buy a stock, it goes down because the trading gods knew you got long. And as soon as you get to a point where you're going to get out and you sell it, then it immediately guns higher. I mean, it's as if someone's over your shoulder watching you, right? We've all had that. Everybody on the call. Well, the positive psychology that options allow is that you have protection. You know what your absolute worst case scenario is in every situation. And that allows you to stay more positive, stay focused on what your objective is, not worry as much about the downside because it's taken care of. And that sort of value that the options bring, I believe, is key. You can use the model to your advantage, knowing time is discounted. There are times when market makers are selling options maybe below what we might think is value. The psychology of that is beneficial. And you can also stop tick watching. And this is on a couple of levels. Look, you're talking to a guy who had spent the better part of 10 years watching every tick of a stock all day, every day. And what I'm going to tell you is doing that will give you ulcers, make your hair gray if it stays in or if it doesn't just fall out. It'll make you miserable. It'll keep you up at night. And the more you have options allowing you to not watch every moment. And then the other advantage being, if we're talking about a swing trade, with technology the way it is now, you can get away from the market and not overanalyze it. Why? Because the downside is taken care of when you do it properly. You don't have to worry about the blowout. You can worry about the profits and manage to that. Get up from your screen. Put your iPhone down. Stop looking at it. It'll drive you nuts. When you have to do that is when you have money. And again, your money is at risk even at options, but you know what the ultimate downside is. When you're trading a stock, you're trading currencies, like things go crazy. You got to be watching it. This gives you the breathing room, and not watching every tick allows you some perspective. And if you don't believe me, go pull up your favorite charting package. I like MetaTrader for currencies. I like our friends over at Thinkorswim. TradeStation has a phenomenal. But go watch, like Rich does with the Cyber Group and Fausto, go watch a 1-minute chart. And then go look at an hour chart and check out the difference, or a 15-minute chart and a 1-minute chart. And I'll tell you, you have to be a certain kind of person to watch those 1-minute charts. I mean, they can drive you nuts. And I think the ability to find what type of trader you are leads to success, because I know people who have to trade those 1-minute charts. They want to be hitting the button. They need to be doing something. I have a friend that trades currencies over in India, and he does trades that are on for weeks and weeks. He's a long-term trader. He couldn't be bothered with anything less than a daily chart. He looks at dailies and weeklies. 5-minute chart, as far as Sunil's concerned, you can have it. Somebody like Rich, he doesn't want to look at daily charts. That's not what he does. But I think if you find what fits your personality, I think if you're somebody who wants to trade a little bit longer term, you envision yourself as sort of a swing trader looking to make decent moves, but not gigantic moves and not micro moves for your profit, I think options can help you do that. And you can also finally scale in and out with options relatively easily. Somebody talked about that a bit earlier. So we've gone over all these benefits: the capital efficiency, superior alternative to shorting, limited loss with risk reduction, the additional means to profit, the position integrity after profit taking, those timely and flexible portfolio protection, income generation method, and the noise cancellation. So I appreciate everybody being with us. Here's a look at some of the people that we work with. I know that we're now using even TradeStation on our Cyber Group. So the next question, you didn't join me for the last 45 minutes, 50 minutes, an hour just for fun. How do we start making some money, Greg? Well, we do have an offer. Not a surprise, but we have an offer. I did a class back in December, a 2-hour focused options, a little bit, we'll call it intermediate, maybe at least intermediate, and it was around a specific topic. What was the topic? The topic was trading stock earnings releases with options. So how to take the volatility that can be earnings using the protection of options to your advantages. It's 2 hours, about 8 different ideas or concepts that we go over. I show you exactly how to do them, how to find options, find the expirations, how to find out what's happened in the past, and different strategies that fit different earnings expectations. We normally charge $97 for that. It's $38 plus the big kicker. You get 1 week of the Cyber Group for free. I mean, it's worth it just for the Cyber Group. And I think we'll also give you next week I'm teaching my intro phase 1 options. I think you even get a 10% discount on that course. People say, hey, Greg, what the heck is Cyber Group? Well, it's a no holds bar, screen up all day long watch of our traders in the market. This is Monday to Friday, 8 to 4, Fausto and Rich and the team. Screens are up all day. You see what we do. You see what the other traders are doing. It's a community built trying to help each other, and you get to watch live for free. There's no better way to find out whether you want to do this, be a real trader, than watch people doing it, making money live. They're trading equities. I get in every day around lunchtime, talk some options. So all this is available to you. $38. Let me go back to that one. Reach out to your educational advisors. They would be happy to help you. Now I'm going to sign off. This is Greg McDermott for Cyber Trading University signing off. Have a great evening. Thanks for joining us.